Lord Skidelsky, welcome to Edinburgh, and I'm sorry you've had a difficult journey. Professor Pete, ladies and gentlemen, good evening. Welcome to the 2009 Angus Millar Lecture. My name is Anne Packard, and it's my privilege as a former trustee in one-time RSA Scotland to introduce this event. First, I think a little about Angus Millar. A lawyer, he devoted most of his life to investment management with Baillie Gifford in Edinburgh, and I'm delighted there are one or two other Baillie Gifford people here. In the 1950s, investment management was a very low-key activity with little or no prestige. And over decades, Angus played a part in building and strengthening the foundations of this sector in the financial world, particularly here in Scotland. He was involved in a wide range of Scottish enterprise, educational and cultural organisations. But he was also perhaps a polymath. He also enjoyed the great outdoors. He topped most Munros in Scotland, as well as exploring less frequented parts of India, Africa and the Far East. He died in 1996, and the following year, his family generously endowed the annual Angus Millar Lecture in his memory. Jeremy, it gives me singular pleasure to introduce you, though to very many of us here you need so little introduction. We've shared a platform a few times before at RSA events, and many of us see you regularly at the David Hume Institute, as indeed we will tomorrow. Jeremy is a member of the BBC Trust, a member of the Competition Commission, as indeed is Bobby Bertram, due to be here tonight. A fellow of each of the RSA and RSE, Jeremy is director of the David Hume Institute and involved in other bodies, including the Industry and Parliament Trust. He retired from the Royal Bank of Scotland in 2005 after 12 years as Group Chief Economist. So who better to introduce our speaker and to chair this evening's proceedings? Jeremy, over to you.
Well, thank you, Anne, and I hope you'll excuse me if I introduce Lord Skidelsky from a seated position. It's a huge pleasure and privilege to chair this event and to have the opportunity to introduce Lord Skidelsky. I mean, his CV is quite phenomenal, and I will be as brief as one can with such an amazing man. He was born in 1939 in Manchuria, of British parents of Russian ancestry, and was interned in first Manchuria and then Japan before being released in exchange for Japanese internees and moving to England. He read history at Jesus College, Oxford, moved on to do a DPhil at Nuffield College, and then went to first the British Academy and then Johns Hopkins University. Johns Hopkins University, for some strange reason, let him slip through their fingers, and he actually went back then to Warwick University in 1978 as a professor of international studies, and he has remained at Warwick University since then. I make that 31 years.
I'm now retired.
He now retired, but moved to the economics department in 1990. Lord Skidelsky is very well known in the economics profession for the biography of Keynes, the 3 volumes that he wrote. He was also a founder member of the SDP, made a life peer in 1991, moved from the SDP to the Conservatives to the crossbenches. He has numerous non-executive appointments and trusteeships, a raft of publications, not least of which is Keynes, The Return of the Master, which I think may be included in the talk we're hearing tonight, which I have had the pleasure of reading most but not all of, although I have skipped to the end and missed out a bit of the middle in my haste. And I know who done it as a result of that. And this book is hugely relevant to today's little problems, and I know has caused a few flutters amongst the economics profession, as it is not always totally flattering to those gentry. So, with no further ado, it gives me great pleasure to ask Lord Robert Skidelsky to deliver tonight's lecture.
Ladies and gentlemen, I'm delighted to be delivering the Arthur Millar Lecture here in Edinburgh, and very happily and wholeheartedly subscribe to the Enlightenment values of the Royal Society of Arts. I did think I'd finished with John Maynard Keynes. I really did. My 3-volume biography had taken 25 years, and enough, I thought, was enough. Then, on the 15th of September 2008, the Lehman Brothers declared bankruptcy, and suddenly Keynes was back in fashion. And I started writing the book to which the chairman has just referred, Keynes, The Return of the Master, on the 1st of January of this year, and finished it on the 31st of March. There are a few updates. I was allowed some updates. So it was a very great big contrast to the time I'd taken on my previous books. It showed I could write a book quickly. Why Keynes now? Why Keynes today? Well, there are two obvious reasons. First, none of the currently dominant schools of economics could really explain why the banking system had collapsed. Even those who warned that house prices were too high never imagined that the banking system would become so heavily contaminated. In short, they missed the devastating potential of virtually unregulated securitization. Secondly, policymakers were confronted by the fact that the collapse of asset prices was followed by the collapse of the real economy, the worst since the end of the Second World War. Both these real-world happenings, the collapse of the financial system and the collapse of the real economy, blew sky-high the two dominant paradigms of contemporary economics: the efficient financial market theory, which was the view that securities are always correctly priced on average, and, of course, the second was the theory of the self-correcting market, the belief that following a shock or a disturbance, wages and prices adjust rapidly to the new equilibrium so that employment is continuous or near continuous. It was their instinctive understanding that these things were untrue that led governments the world over to start stimulus packages in an effort to avert a slide into another Great Depression, first by bailing out the banks and then by direct action to maintain aggregate demand. And I call the dominant school, for shorthand, Chicago economics. And I say that as a, I hope, an allowable simplification. I know that not all economists subscribe to the doctrines of the Chicago school, but that has been the dominant school, especially in macroeconomics, over the last 25, 30 years. Well, let me start with their failure to explain the slump. If financial markets are efficient, what Alan Greenspan called the underpricing of risk worldwide couldn't have happened. And it's characteristic of this class of theories that when things do go wrong, they blame it on the government. As the Reaganites used to say, or as Reagan, I think, used to say, government is the problem, the markets are the solution. But in this case, as George Soros rightly pointed out, the salient feature of the current financial crisis is that it was not caused by some external shock. The crisis was generated by the system itself. And it's to Keynes that we owe the original concept of financial instability, an idea subsequently taken up by his follower Hyman Minsky. People often talk about Minsky as saying something contrary to Keynes, but Minsky was a Keynesian, and he just drew out this strand in the general theory and developed it into the Minsky theory of financial instability, but I call it the Keynesian theory. And the way Keynes did this, made the point about financial instability was by putting uncertainty at the heart of his economics. I want to spend a moment on that. No proposition about the current crisis has been more generally accepted than that it was caused by the mispricing of risk. For 2 years, economics has been dominated by the discussion of risk. You just can't read any financial section of any newspaper without coming across risk. Mismanagement of risk, mispricing of risk, banks fail to manage their own risks, regulators fail to manage systemic risk, the risk that the mismanagement of individual institutions would become correlated, and so on. The key to the prevention of further crises, therefore, lies in the better management of risk. The better management of risk by banks, the better management of risk by regulators, more transparency, and so on. Those are the main lines on which the reform project takes place, with risk as the essential variable, the essential joker in the pack, somehow, that has to be managed. But this whole discourse depends on the assumption that risks can be correctly priced. On this view, what Greenspan called the underpricing of risk worldwide must be due to some failure of information somewhere. And that's not what Keynes said. Keynes put irreducible uncertainty at the heart of his explanation. His economics is about the strategies we adopt to rob uncertainty of its sting, the frequent breakdown of these strategies, what governments should do when economies break down, how they should act in order to minimize the chances of breakdown. Now let me just talk about these four things very briefly. Here is Keynes's canonical statement concerning uncertainty. I quote, "By uncertain knowledge, let me explain, I do not mean merely to distinguish what is known for certain from what is only probable. The game of dice is not subject in this sense to uncertainty, nor is the prospect of a victory bond being drawn. Or again, the expectation of life is only slightly uncertain. Even the weather is only moderately uncertain. I think it's pretty certain, actually. It's going to be bad." The sense in which I'm using the term is that in which the prospect of a European war is uncertain, or the price of copper and the rate of interest 20 years hence, or the obsolescence of a new invention, or the position of private wealth owners in the social system in 1970. About these things, there is no scientific basis on which to form any calculable probability whatsoever. And he uses to illustrate this an apple, which he equips with human characteristics. And then he writes, "It is as though the fall of the apple to the ground depended on the apple's motives, on whether it is worthwhile falling to the ground, and whether the ground wanted the apple to fall, on mistaken calculations on the part of the apple, on how far it was from the center of the earth." And so he develops this thing, and of course he says, well, maybe the apple did miscalculate, the distance from the tree to the earth. Well, in that case, better information, of course, would have solved the problem. That's the risk theory of why things go wrong. But then you see he zooms in on the motives. The motives, he says, does the apple want to fall to the ground? This is the human situation. And we can imagine many situations in which the apple doesn't want to fall, might not want to fall into the ground, might be too dangerous or something like that. Or more likely, the apple waits to see what the other apples decide to do before taking the plunge, or perhaps it prefers the company of apples in the tree to this sort of lonely dive onto the ground. And I don't want to go any further at the moment, but it's simply to establish the point that Keynes made, that economics is not like physics. It's not like physics because it deals, I quote, with introspection and values, with motives, expectations, psychological uncertainties. And I think the trouble with economics, and I shouldn't say this in Edinburgh, I mean, and this is the home of the Enlightenment, economics really suffers from physics envy. They want to be like natural scientists. They want to be as in control of their material as natural scientists, but people are not atoms or apples. They have, as Keynes says, motives, values, and intentions of their own. So, how do we deal with uncertainty? Well, what we do is, Keynes said, we transform it into risk. That is to say, we give it numbers. And this is the job of mathematical forecasting models. The problem is that in many cases, these numbers are spurious because they have no objective probability counterpart. We sort of say, well, let's assume this. Let's assume there's this much risk. And then we have a bit of data, and then we think that, in fact, the weights we assign correspond to some objective probability. But often it's lacking. It isn't really there. So why do we use these numbers? Well, we use these numbers in order to allay our anxiety, to feel that we've got some solid ground to stand on. And what Keynes says is that our mathematical forecasting models are based on conventions. And he highlighted three of them. The first, that the present will continue into the future. This is the extrapolation convention, based on a very crude inductive principle. And we all know what happened to the chicken who believed in the inductive principle. You know, every day it stretched out to eat the grain that was provided for it, and one day the hand wrung its neck. That was what a misplaced belief in the inductive principle can do to you. Secondly, a second convention that we work on is that existing share prices correctly sum up future prospects. And that's roughly what the rational expectations hypothesis says. And the third convention is that if most people believe in something, it must be right. That's following the law of large numbers. If everyone is saying this, it must be right, mustn't it? And so these are the sort of conventions on which people act, and they're all conventions which are designed to tame uncertainty in some way, to give us a feeling that we know what's going to happen. And they're compatible, Keynes says, with a great deal of stability in our affairs, as long as the convention holds. But they're liable to sudden overturn when some passing bit of news, needn't even be a very significant bit of news, but some passing bit of news upsets them. And then everything goes wild because there's no firm basis of conviction to hold them steady. Then, as Keynes says, the practice of certainty and security suddenly breaks down. New fears and hopes will, without warning, take charge of human conduct. All these pretty polite techniques suitable for well-panelled boardrooms collapse. And that, I think, is exactly what happened last autumn. Part of this uncertainty here attached to future-looking events is captured by another rather fascinating but neglected part of Keynes's theory, and that is that people were more prone to save than to invest. In other words, the desire to save at all times historically was stronger than the desire to invest. Uncertainty lies at the heart of this. When the future's uncertain, there will be a permanent bias to security, that is, to preserving value rather than creating new value. Keynes believed that enthusiastic investment, and there have been periods of enthusiastic investment, came in bursts. That's what he called animal spirits. When everyone got very optimistic about something, it might be a new invention, it might be, some incredible piece of good news, it might be the election of a Conservative government, or Labour government, rarely Labour government in a business environment, but something that makes people optimistic. And then they want to, then they feel the future's better, they want to invest more. And these animal spirits were what drove the investment process in Keynes's view. And we've had examples of them, the railway boom of the early 19th century, and the last one being the dot-com boom, which exploded in 2001. But normally, we don't have these great upsurges of optimism. Normally, people prefer to hoard rather than invest their money. As Keynes put it, they normally had quite a strong tendency to liquidity preference. Keynes was interested in history. I studied economics after I first studied history, and Keynes studied history after he first studied economics. And Keynes had very interesting theories of history. And one of them was he discovered quite early on in his historical studies that Asians, East Asians, were very addicted to hoarding money, hoarding gold. It was Jevons, after all, who described India as the sink of the precious metals. And at the same time, the Chinese hoarded silver. Keynes wouldn't have been surprised about this, and he said, in the long span of history, Asia has set the West a permanent deflationary problem. And the global imbalances of which we speak today are, in a way, the reappearance of an ancient pattern, because hoarding is the classic response to uncertainty, with hoarding at its greatest when politics are least predictable. And so, in a way, history never repeats itself exactly, but you see these recurring patterns, excess saving by East Asia today as the source of the slump in the West, is compatible with Keynes's theory, of course, because it's when savings are in excess of investment, that's when economies run down. But here you have it globally as part of a recurring pattern of history. Now, the second point, when I say that the classical economics can't explain the contraction of the world economy which started in 2008 and which followed the financial collapse. About 4% of contraction in the United States, and 8 million extra unemployed, and I think our economy is projected to contract altogether by about 45%, with a doubling of unemployment. Because the classical or Chicago economics assumes continuous or almost continuous full employment, based on rapid adjustment of wages and prices to new conditions. What most normal people call unemployment is, for the Chicago economists, a voluntary choice for leisure. And they're acting efficiently. They've just decided it's not worthwhile working. It seems a perfectly rational decision, especially when no one's offering you a job. And what Keynes explained was why economies slide downwards, and why you don't have this almost continuous clearing of markets at full employment. And the term economists give to his explanation, or the Keynesian explanation, is called sticky prices, sticky wages and prices. And I think people have had a lot of trouble with this. People schooled in the classical economics can't understand why wages and prices should be sticky. Well, why doesn't supply and demand adjust instantly in the labour market? And they can't get there. Whereas Keynes did get there. He said that the wages and prices are sticky because people don't know at the moment when an economy, employers have started to lay off people, and when employment has started to fall and demand has started to fall, workers don't know what the new equilibrium wage is. So they hold off offering labour services long enough for output losses to develop. And it's not that wages and prices are absolutely rigid. They do adjust, but they don't adjust as fast as output adjusts. And that's because of uncertainty. People don't know what wages they should accept jobs for when unemployment is rising, when demand is falling, when prices, or the growth of prices, as we would now say, has deaccelerated. What is the new correct money wage that they should be accepting? And so uncertainty enters into labour markets. And then as output falls and spending falls, then you can get a situation in which the economy runs down in a multiplied way and an underemployment equilibrium is established. Now the third sort of real use by Keynes of his theory. Keynes argued that in a situation of rapid output decline, it's the government's duty to provide a stimulus, an external source of spending to replace the shortfall in private spending. The theory of the stimulus is very, very simple, so simple that few Conservative spokesmen can grasp it. The volume of output and employment is determined by aggregate demand or spending. Aggregate spending is made up of private spending and government spending. If something happens to reduce the amount of private spending, government spending has to increase to plug the gap if full employment is to be maintained, normally by running a budget deficit. The extra spending by government will cause not only public but private spending to revive, since when workers who get jobs as a result of government programs spend their money, that's income for other people, and other people start buying goods and services which they wouldn't have been able to buy had they been unemployed. As aggregate spending increases, the budget deficit will automatically reduce, since government revenues rise faster than national income. And once the economy starts growing, but provided budgets return to balance, the national debt will start coming down automatically. And that, in a nutshell, is the theory of the stimulus. Very, very simple. It's all really arithmetic. Now, of course, it leaves out lots of things like confidence, expectations, and so on. But it's sort of, at that aggregate level, it's not really very, very difficult to understand, and it's not that difficult to apply. I don't know whether it's intellectual incompetence or intellectual dishonesty that causes George Osborne and leading Conservatives to call for cutting government spending now, when the economy has contracted by 4 to 5% and may still be falling. And one could really, it would be a perfectly reasonable electoral slogan, in my view, for this government to say, vote Conservative for more unemployment. And that would be the consequence of their policy. If they want to cut spending now, before the economy has recovered, that is a recipe for higher unemployment. There's no doubt about it. Fortunately, A, they're not in a position to do it, and B, if they were in a position to do it, they wouldn't do it. It's simply the privilege of an opposition. I think it's rather irresponsible, but I'd like to see this argument really joined. It started to be joined yesterday when Brown and Cameron had their argument just about this particular point. Now, of course, the other thing that's been said now is, fiscal policy is no good. Because it leads to insolvency of the government sooner or later. But monetary policy may be all right. So monetarists have come out of the woodwork now, having for a long time argued that money is neutral. They now say monetary expansion can now bring the economy back to full employment. Well, Keynes, of course, did favour cutting interest rates in a recession. Anyone would. But he didn't think it could do the job on its own. And the reason was it might be too difficult to get the cost of capital down to really low rate if hoarding is going up at the same time. And we know this. Although the base rates have come down to very, very low levels, there is still a gap between base rates, a higher gap between them and what banks are prepared to lend than there was before the recession started. So banks are not, the government's flooding the banks with money, but the banks aren't lending it at rates at which enough people are prepared to borrow to cause investment to recover. And the other bit of it is that, in fact, confidence is damaged and businesses don't see the demand, so they're not as willing to borrow. And so, interest rate policy, while necessary, is too unreliable and maybe weak an instrument to bring about a reversal of the fall of demand. So, you have Obama and Brown rightly doing what needs to be done to howls of execration from some. Now, in conclusion, let me turn to 4 implications of taking uncertainty seriously. First, what sort of macroeconomics should we teach if we take uncertainty seriously? Its basic axiom cannot be rational expectations theory as it is today. All economics assumes rational expectations, and I think that's wrong. What we should start from is a different axiom, and that is irreducible uncertainty. That's to say, the economics we should teach would accept the highly contingent character of any forecasting models, whether micro or macro. This establishes the right attitude of skepticism. Skepticism, good Enlightenment skepticism, to the claims by forecasting models that they can accurately predict the future. And that skepticism is the right intellectual context for policy interventions. Now, on the policy intervention side, I think we have to think of developed countries and developing countries differently. For developed economies, the uncertainty mainly applies to the economic parameters. The demand for greater transparency, as I've said, comes out of the risk, the imperfect information model. But uncertainty management leads to a different set of policy conclusions. For the financial system, it means not just creating greater transparency in accounts, transparency which will always be illusory. Because the people, there's so much scope for creative accounting, so much scope for defining capital in various ways, even when you get regulatory requirements for increasing capital ratios. All that, it's not going to work. And what you have to do instead is to build firewalls between different financial institutions so that they can't infect each other simultaneously. And I call this Glass-Steagalism for short. I'd like to see banking broken up into 3 sectors. Deposit banks, which make loans to depositors, their depositors, building societies, which make loans to home buyers, and investment banks, or what used to be called merchant banks, which have private investors placing their money with them at their own risk. And that's not consistent with these other proposals, but it is a recognition that just trying to increase transparency, just trying for macro-prudential regulation of the banking system isn't going to be enough. And we'll also need to revive fiscal policy in some form or other in support of our full employment target. I'd like to see a fiscal responsibility committee set up, and that is something the Conservatives have proposed, on the lines of the Monetary Policy Committee, to decide when discretionary changes in the budget balance are called for. So that's how I would proceed to tame uncertainty in the developed economies. For developing countries, I think the main focus has to be on reducing political uncertainty. You see, in our sort of society, we can take political parameters as fixed. It doesn't matter that much for macro policy, whether it's Conservative or Labour, or whether it's Republican or Democrat. There's very little political uncertainty in our kind of societies, whereas in developing societies, political uncertainty is huge. The political parameters are always shifting, and therefore aid should be channeled towards reducing political uncertainty. That's something I said to I was in Washington last week, and I gave a lecture on this particular matter at the World Bank. And there was quite a lot of agreement with that. Because there's nothing new here. It's Adam Smith in 1776 wrote that a country had reached a stationary state when it had its full complement of the riches which the nature of its laws and institutions permitted to acquire. A lot of sub-Saharan Africa is in a miserable, stationary state condition. It doesn't grow, well below any thing that we would regard as enough. And a lot of that's due to free market dogma. The belief that markets will solve any problems, you don't need to worry about governments, markets will do it for you. Finally, for the international financial system, the three requirements which might follow from taking uncertainty seriously are centralization of international reserves in an institution like the IMF, the management of exchange rates, and capital controls. Each is based on the principle of reducing uncertainty. The reserve accumulation of the last few years by East Asian countries is partly an effect of their experience of the flight of currencies, capital in 1997, 1998. And that reserve accumulation, the proportion of reserves to world GDP has gone up by 3%. In the last 5-6 years. And that would itself account for the great slump. It's both a cause and an effect of the great contraction. So I think that these are the thoughts I'd leave with you. One could reach these conclusions by other routes. But I think concentrating on uncertainty, as Keynes did, gives you a better theoretical justification for doing these sort of policies than any available alternative. Certainly not anything that is taught and believed in the dominant models of economics today.
Thank you very much indeed. I think that was amazing in that relatively short period to both go over Keynes and insights into the causes of what happened and to then a very rapid run through the solutions and the way forward. What has been suggested to me is that I might abuse my position as chair for 10 minutes or so by having a brief conversation on some of these issues in order to perhaps to make you think of particularly pertinent questions that you want to ask. So just for a few minutes, if we may, Lord Skidelsky, just pick up a couple of points that you've made. Uncertainty. It's one of the things that aggravates me when talking to people is this confusion between risk and uncertainty. Now, what I'm taking that you're saying is that uncertainty essentially are elements to which you cannot attach probabilities in any rational manner. They are inherently uncertain. Is that right?
Yeah. It's not a question of zero probability or 0.1 probability. You don't know what the probability is.
Right, and that is different from a black swan in a sense,
it is.
Which is a black swan that is very unlikely, but you can attach some probability to it, even though it's very small.
It is. And I made this point in my book, and then when I was in New York, I had a very interesting conversation with Nassim Taleb, who was the author of the Black Swan book. And I said, well, you're not really uncertainty, you're just very, very low probability, you're fat tails, really. And then he said, well, I think that's a misunderstanding. And I said, I didn't make it clear in my book exactly, but I'm writing a new book to make it absolutely clear. Because I think when you get into those very, very low areas of uncertainty and you have these unpredictable events with huge impact, the resulting situation is completely uncertain. So in other words, he thinks that black swans produce uncertainty, even though themselves they're not technically uncertain.
Okay.
So it may be that they come to the same thing. It may be, but
But the fact that there is this probability of inherent uncertainty that cannot be quantified in probability terms leads to the inherent lack of certainty of any forecasting, however good the risk models are, however well-founded the data and the information are. There are things that just are there lying behind, which means that the lovely quote from, I don't think it was Keynes, but the fact that there are two types of economic forecasters, those who don't know and those who don't know that they don't know. And what you're saying is inevitably there is that uncertainty which remains. And rational expectations theory just therefore does not pertain.
It doesn't pertain. It assumes that the information is, broadly speaking, adequate to sustain any types of forecasts that you might be interested in making. I should just say this, though. I don't think uncertainty applies to every future situation. It obviously, as Keynes said, certain things in the future are quite probable. Certainly, you can. Consumer expenditure over short periods. We can assume that we can assign probabilities to them. He was thinking particularly of the investment function, where we're investing. If we're a long-term investor and we're investing in a new piece of machinery which will only start, which has a long gestation period and will start, and we expect it to produce a stream of income for us over the years, we have no scientific basis really for judging whether that investment will produce its promise or not.
Right. Now, in your book, you go on to describe three types of failure, three kinds of failure that led to the nasty incident that we're still going through: institutional, intellectual, and moral. On institutional, I was interested in what you were saying about banks, your idea for three types of banks and for firewalls. Do you believe that increasing regulation, as proposed by the Turner Review, as proposed at the moment by the government of this country and I suspect the United States, can that ever achieve a reasonable guarantee of security in the financial sector, or will it inevitably lead to the clever investment bankers and others finding ways round whatever regulations are put in place?
I think, again, you can probably do something by regulation. I think you can demand minimum margins, and especially say for aspiring homeowners, you can say, you must have a certain deposit. It must be a proportion of the value of the house you're buying. You can say that, and I think it'll probably work. So there are areas where you can actually, by laying down certain standards. Banks used to do this anyway, and it's just that their own sort of regulation of these things went to pot at some point. For various reasons which have been analysed. But broadly speaking, I think the regulations will be gamed. There are two problems, I think, with laying down capital ratios. I think you can try, but I think one is, there's one problem with capital ratios which is to do with balance sheet manipulation. What counts as capital? You can say, yes, Tier 1 capital, you've got to have a certain proportion of this, and so on. But then Tier 1 capital becomes subject to manipulation. Tier 1 capital used to be AAA government bonds. But then other things became AAA, which weren't really meant to be AAA at all. And so in that way, the quality of your capital deteriorated. That's one thing. If you then sort of say, well, let's go beyond that and have a macro-prudential counter-cyclical policy, which is that banks' capital requirements should vary with the cycle, so that as you get into the boom period of the cycle, their capital requirements would go up, and in the downswing they would go down. That presupposes you know where in the cycle you are. So there are all kinds of knowledge requirements. This is quite apart from the fact that regulators tend to be outwitted by clever traders and quants and all those sort of things, and they're paid much less to start with.
And then they're easily captured by banks who pay them more.
Easily captured. So I would like to sort of say, no, you just can't do this sort of business.
Okay. Two quick further points before I just invite question. One is very interested in your suggestion that we need a return to discretionary fiscal policy. Basically, you're referring back to the fact that we now have the one club golfer in policy, only monetary policy. You want macro policy back, fiscal policy back.
Yeah, because I don't think, the minimum reason for it has to do with if you believe that there is a big problem with the so-called floating exchange rate system, that is, that some currencies simply don't float, they're fixed. And what happens is that the renminbi, as you know, is fixed to the dollar. And when the dollar depreciates against the euro, instead of saying, all right, well, the renminbi will naturally appreciate, the Chinese keep it fixed. Yeah. So you are entering into this world of competitive currency depreciation, which of course, was true of the 1930s. And Europe is getting into the position of having a very overvalued currency against these others, which is what the position of the franc was in the 1930s. So if you want to get out of that, and you say, okay, we must have some agreement on exchange rate management, you haven't got the instrument for doing it. You can't manage the exchange rates and control inflation with one instrument. That's why you must think of another instrument, and fiscal policy sort of comes back into the reckoning. Now, I do think we've got to learn from the mistakes of fiscal policy as it was operated, 30 years ago. But after all, there is some learning is possible. I'm very, very convinced that one's got to rethink the role of government in a constructive way. Governments did make mistakes, and they threw out the baby with the bathwater. That was the trouble. There were things governments did wrong. Everyone knew what they were. There was a lot of waste. There was a lot of corruption. There were a lot of things that went wrong. Now we have to sort of try and get government back, but without purged of some of these faults.
Well, I'm sure everyone's desperately waiting to come in, but one last reaction to that, which is you referred to China, you referred to America in your book. You say the problem is that rather than Chinese savings fueling American investment, Chinese savings fueled American consumption. Yeah. And these imbalances that I was worried about 6-7 years ago, are still with us. Yeah. And even if we solve the banking crisis, even if we get macro policy better placed within economies, your international financial system recommendations are related to trying to deal with these horrendous structural imbalances within the global economy. Is that right?
I think that's where the big thinking has to come, and it's going to be very, very difficult. I think Gordon Brown tried, but in some sort of ham-fisted way. He suddenly came out with the idea of a Tobin tax, which could be, that is a sort of part of a system of controlling the international mobility of capital, particularly preventing having fewer hot money movements. But it wasn't related to a strategic design. It may be we do need to re-enter a world in which capital flows are much more heavily controlled than they are today, because they've caused a lot of the damage. And although people say, well, look, you should have international freedom of capital movement because that secures the most efficient allocation of capital globally. Now, that is true if it doesn't also cause great big crashes, because then you have to weigh up the benefits of somewhat more efficient allocation of capital against the losses of periods of 5 to 10 years of subnormal activity, which is what we may well be facing, produced by that very capital mobility. So it's a matter of balances, and I would argue that that in the period when capital was much more severely controlled internationally than has been recently, we had very satisfactory rates of growth. This I'm talking about the 50s and the 60s. The performance of the global economy was better then than it has been since.